Hey, what's up guys? John here. For the last 18 months or so, I've been predicting a housing crash, a really big housing crash. And over the last 12 months, home prices have steadily been decreasing in most metro areas throughout America. And as of today, Redfin reported that over $2.3 trillion in property value and property equity has now been lost. This does not take into consideration all the disasters that have been happening throughout America over the last few weeks that you've probably seen on the news, whether it be Ohio, South Carolina, Texas, Michigan. All of these situations could add to this number, especially as Jerome Powell continues to increase interest rates and we start to see this affordability crisis continue to escalate. That being said, I do believe we're going to be stepping into a massive opportunity to invest in real estate and a great opportunity to start new businesses. There's going to be a ton of opportunity, but there's going to be a lot of pain to be felt. In this video, I'm going to walk you through exactly what this is going to look like and what you can do to prepare for this. Please hit the like button. When you hit the like button, YouTube's going to share this content to educate more people about what's really going on. I mean, last year, about 9 months ago, 10 months ago, I formed a credit repair business called GreatCreditFast.com, where we're helping people fix their credit. The reason I tell you this is because you just have to spot the trends. It's more than likely, my belief anyway back then was it's more than likely we're going to start to see increased defaults. We're going to start to see more people missing payments. We're going to start to see more situations of people's credit report. And as the economy changes, banks are going to tighten up their lending restrictions. They're only going to lend money to people with good credit. That was my belief. And so far, I'm spot on. As of now, there's over 105 million Americans with a credit score below 700. And that number is going to continue to increase. And we look at this right now, there's US homeowners have lost $2.3 trillion in equity. What's absolutely crazy is how some of these markets are really just getting beaten and battered compared to other markets. Some markets in South Florida are still holding up extremely well. But if you look at a location, for example, like the Bay Area, the values right now, they are at 2015 levels. 2015 levels. San Francisco, the median price of single-family houses plunged 33%, or by $675,000 from the breathtakingly idiotic peak of March 2022, falling from 2.06 million to 1.38 million in 10 months. Year over year, the median price plunged. The median price in January is about even with January of 2019, the first time that the median price hit $1,038,000 was February 2016. The spring selling season better be good. But there's some other interesting things that have happened over the last couple of years. People were moving from expensive locations, expensive cities, to suburbs and other locations. And they were buying properties that they could afford at that time and getting 2.5%, 3%, 3.5% mortgages. However, what's happened is now we're starting to see massive layoffs. We're starting to see utility bills and property insurance and basic living costs skyrocket. So what someone could have once afforded, every single day it just gets harder and harder to afford it. And we're going to start to see all this translate into what I believe is going to be a big opportunity for real estate investors in 2023, 2024, 2025. Take a look at this. So the total value of US homes was $45.3 trillion at the end of 2022, down 4.9%, $2.3 trillion from a record high of $47.7 trillion in June. That's the largest June to December drop in percentage terms since 2008. Since 2008, I'm going to leave this pinned in the show notes below so you can read this. Right now, 22% of U.S. adults owe money on a home equity loan. What are people going to start doing when they enter an affordability crisis? They're going to start borrowing money. Home equity lines of credit. They're going to start using personal loans, credit cards. They're going to do whatever they can do to try to bridge the gap, because people are hopeful that when they start to decrease interest rates, asset values are going to start to appreciate because of it. But if you look at Jonathan Gray, the head of BlackStone, his real estate division, he believes interest rates are going to be elevated for an extended period. You look at Sam Zell, founder of Equity Group. He owns Equity Residential, Equity Office. What is he saying? He's saying that interest rates are going to be here for a while. High interest rates are going to be here for a while. Carl Icahn, same exact thing. They're all saying the same thing. Don't fight the Fed, and that this is going to be a brutal period. Now, what is this going to look like for investors? Now, I learned a very valuable lesson with home equity lines of credit. This happened to me a few years ago. I took out a home equity line of credit for $250,000, and it was at a 2.96%. 2.96% at that interest rate. I mean, who can turn it down? I borrowed the money. I was making the monthly payments of, it was like something like $200 or $300, something like that, nominal payment every single month, and I was using the money for construction. However, at the end, there was like an 18-month or 24-month period in which the rate would then adjust to market. And it went from $200 to $300 to somewhere like $700 to $800. So it just skyrocketed. Fortunately, I had the money. I was able to just pay it off. But let's say I didn't have the money, right? Let's see, a lot of people are probably going to be in that situation. They don't have the money. They're hoping to bridge it. We're even seeing a lot of people jump into adjustable rate mortgages. That's going to be a big problem. It's going to be a very, very big problem. One of the biggest landlords in Los Angeles just defaulted on a $755 million in loans for 2 skyscrapers as remote work keeps offices vacant. We're going to start to see a lot of very interesting things happen in real estate. I think there's going to be many opportunities to get into real estate as an investor. You just have to be extremely cautious of what is actually happening, where things are actually going. Because if you understand where things are actually going, you're going to be able to plan ahead. You look at Los Angeles, they're starting to do some really, really big curveballs to property owners, to investors, to landlords. You're seeing the same thing. They're talking about bringing in moratoriums back into certain sections of the country. So they're starting to talk about these changes. We're going to start to see all these changes hit. Because what ultimately will happen if you start to see a wave of foreclosures, defaults, you're going to start to see an affordability crisis. What will happen is people are going to start voting and demanding more of an equitable, fair place to live, something more affordable, more restrictions. They're going to start to vote for things like this. So be cautious of where you're investing. Pay attention to what's actually happening behind the scenes. Even right now, Biden's talking about a renter's bill of rights where it would give tenants a bunch of rights over the properties in which they're renting, right? So all of these things will become much more weighted and taken much more seriously by the general public if we start to see a wave of foreclosures, a wave of financial problems across the real estate market. People are going to start to demand these things. So I do believe there's going to be huge opportunity for the smart and savvy investor. I mean, look at this right now. National Association of Realtors reports memberships dropped from 1.6 million to 1.5 million. So already lost 100,000, already lost 100,000 realtors in just the probably past 6 to 12 months, 100,000. Now in 2008, that number was about 1.1 million. So you look at where we are right now, we still have a ways to go. But there's a lot of different things happening now that were not happening in 2008. In 2008, food costs were stable. 2008, utility bills were stable. Insurance, relatively stable. The economy, sure, got beaten and battered. Sure, stocks got crushed, real estate got crushed, yeah. But they didn't have the geopolitical problems that we have right now, where there's discussions of food shortages, there's discussions of hyperinflation and all these different things that we're seeing in other countries right now. There wasn't those fears, right? Now we're starting to step into an atmosphere in which anything can happen. And I personally think what we're going to start to see is the first thing that's going to happen is probably going to be real estate, and people start to default on properties and large debt commitments that they can no longer afford. What do you think about this entire situation? Where do you see this housing market going? I mean, $2.3 trillion so far is something that we should all pay attention to. Because you look at this dip, this is probably late 2021, early 2022. It's just starting to really come down. But if you look at that compared to 2008, I mean, we are following a similar course. It'll be interesting to see what Jerome Powell does the next few meetings, because if he continues to increase interest rates, that will 100% have a very big impact on people's affordability, simply on credit cards, on auto loans, on adjustable rate debt. Everything is just going to get so much more expensive, and they're not going to be able to, people aren't going to be able to refinance. The higher rates go, the more likely it's going to be people are not going to get qualified for a refi. They're simply not going to be able to afford the payments. People are going to start walking away from properties. And when that happens, smart and savvy investors with knowledge, cash, good credit are going to be out there, and they're going to go and pounce on deals. Same thing happened in 2008, 2009. The big private equity groups, what did they do? They ran out and scooped up properties by the thousands. They were using a simple model, the discount to replacement value model, which is simply they were looking at the value of the land versus the cost to actually build these properties. And then what they were doing is simply saying, okay, the cost to build is about $200 a foot. A 2,000 square foot property costs about $400 grand to build it. the land's worth 200, maybe the property's worth 600. Let's make an offer at 50% of discount to replacement. So they're like, okay, I'll write a check for 300 grand, all cash at an auction, and they would go $1 more than everyone else as long as it hit a certain threshold. I think the same thing is going to happen again, where cash is going to be king, strategy is going to be king, credit is going to be king. All these things are going to be very, very important. You just have to make sure that you're positioning yourself for the change that's coming. What do you think about it? Drop below, hit the like button. If you need help fixing your credit, we'd love to help you at GreatCreditFast.com. Give us a call today at 561-430-5900, and follow me for short form content on Instagram, LinkedIn, and Twitter. I'm posting a lot on Twitter now. Catch you guys in the next video.